Thanks for watching. If you like our channel, please subscribe now, then you will not miss any videos in the future. Have you ever wondered how Warren Buffett, one of the most successful investors in the world, minimizes risk in his investments? Well, the answer lies in a simple yet profound concept known as the margin of safety. This concept is not originally from the world of finance. It's borrowed from engineering, but it has become a cornerstone of Buffett's investment philosophy. So, what is the margin of safety? In essence, it's a buffer, a safety net that protects investors from unforeseen events or errors in their analysis. It's the difference between the true worth of a stock, its intrinsic value, and what the market is willing to pay for it, the market price. It's like buying $1 for 50 cents, providing a cushion against potential losses. Let's break it down further. Firstly, we have the intrinsic value. Buffett believes that every stock has an intrinsic value, a real worth based on factors such as earnings, dividends, cash flows, and growth potential. It's not always precisely calculable, but Buffett aims to estimate it as accurately as possible through comprehensive analysis. Secondly, there's the market price, which is what investors are currently willing to pay for a stock. This price can be influenced by a myriad of factors, including investor sentiment, market trends, and macroeconomic conditions. And then we have the margin of safety itself, the difference between the intrinsic value and the market price. It's the discount at which an investor can buy a stock below its intrinsic value. Buffett insists on a significant margin of safety when making investment decisions, providing a cushion against potential losses if the market price were to decline, or if the investor's analysis proves to be overly optimistic. Buffett's approach to investing is akin to playing bridge, where patience and discipline are key. He waits for the right opportunity and isn't afraid to pass if the cards aren't favorable. This approach has served him well over the years and is a key reason for his long-term success. Now that we've set the stage, let's delve deeper into each component of margin of safety. First, let's talk about intrinsic value. This is a term that Warren Buffett often emphasizes when discussing his investment philosophy. Intrinsic value refers to the true worth of a stock, and it's based on a variety of underlying factors. These can include the company's earnings, dividends, cash flows, and growth potential. Imagine you're at an auction, and you see a rare antique vase. Its intrinsic value would be based on its age, condition, historical significance, and the demand from collectors. Now apply the same concept to a stock. The intrinsic value of a stock is its real value, considering all its tangible and intangible aspects. However, intrinsic value isn't always easily calculable. Sometimes it's more of an educated estimation than a precise calculation, and that's perfectly fine. Buffett himself acknowledges this, and he strives to estimate the intrinsic value of a stock as accurately as he can, using thorough analysis and due diligence. Why is this so important? Well, intrinsic value provides a baseline, a starting point for investors. It helps them determine whether a stock is underpriced or overpriced by the market. It's a tool to identify potential investment opportunities. Intrinsic value is the foundation upon which margin of safety is built. Now, on to the next component. Next, we have the market price. The market price of a stock is, quite simply, the price tag that the stock market puts on it. It's what investors like you and me are currently willing to pay for a piece of that company. This price is ever-changing, influenced by a multitude of factors. Let's imagine the stock market as a bustling, lively marketplace. The stalls are the companies, and the goods they're selling are the shares. The price of these shares can fluctuate just like the price of apples in a fruit stand, based on supply and demand. Investor sentiment plays a big role. If investors are bullish, they're optimistic about the future and willing to pay more for stocks, driving prices up. On the other hand, if they're bearish, they're pessimistic and less willing to buy, which can bring prices down. Market trends also come into play. Trends can be driven by a variety of factors such as changes in the economy, political events, or even societal shifts. These can cause waves in our marketplace, pushing some prices up and pulling others down. Macroeconomic conditions, like interest rates and inflation, can also affect the market price. For example, when interest rates are low, investors may turn to stocks as they seek higher returns, and this increased demand can push prices up. Now that we understand market price, let's explore how it interacts with intrinsic value to create the margin of safety. Finally, we reach the heart of the matter, the margin of safety. This principle is the secret sauce in the recipe of Warren Buffett's investment success. So, what is it exactly? Well, the margin of safety is essentially the difference between a stock's intrinsic value, that is, its true worth, and its market price, the price for which it's currently being sold. It's like buying a designer bag at a thrift store. You're paying far less than what it's truly worth. But here's the kicker. Buffett doesn't just look for any old margin. He insists on a significant margin of safety. This isn't about snapping up a bargain here or there. It's about having a substantial buffer in place. Why? Well, this buffer protects against potential losses. Think about it. If you buy a stock for less than its intrinsic value, you're cushioned even if the market price drops. You've already paid less than what it's worth, so you're less likely to lose money. But there's more to the margin of safety than just protection. It's also about acknowledging the inherent uncertainty of the market. No matter how much research you do, no matter how many trends you study, the market will always be somewhat unpredictable. The margin of safety is a humble admission of this fact. And finally, the margin of safety is a testament to the importance of patience and discipline in investing. Buffett often likens investing to playing bridge. You have to wait for the right hand, and if the cards aren't in your favor, you need to have the discipline to pass. It's not about making quick, risky moves. It's about waiting for the right opportunity, where the reward outweighs the risk thanks to a healthy margin of safety. By investing with a margin of safety, Buffett protects himself from market uncertainties and minimizes the risk of permanent capital loss. It's a testament to the importance of patience and discipline in investing. So what have we learned about Warren Buffett's margin of safety? It's a fundamental principle that hinges on understanding a stock's intrinsic value, its market price, and the difference between the two. This margin of safety, this buffer, is what protects investors from unforeseen events and errors in judgment. It's a tool for risk management, a shield against the uncertainties of the market. Remember, investing is a game of patience and discipline. As Buffett himself often says, the stock market is a device for transferring money from the impatient to the patient.